All right, let's dive right in. Starting in March 2026, a new federal rule from FinCEN, that's the Financial Crimes Enforcement Network, is going to change how certain real estate deals are reported. Our goal today is to give you a really clear, simple compliance checklist so you can navigate this new requirement with confidence.
So you might be asking, why this new rule? Well, this quote really says it all. For a long time now, the U.S. real estate market, especially those all-cash, non-finance deals, has been, let's face it, a great place to launder money. This new rule is FinCEN's big move to shine a light on these transactions, boost transparency, and make it a whole lot harder for bad actors to hide behind anonymous companies and trusts.
So here's how we're going to break it all down. We'll start with the basics of the rule, then we'll walk through a simple checklist to see if a deal is even covered. After that, we'll look at some key exemptions, figure out who's actually responsible for filing the report, and then wrap up with the must-know compliance takeaways.
Okay, first up, let's get a handle on the fundamentals of this new residential real estate rule from FinCEN. In plain English, this rule is laser-focused on a very specific slice of the market. We're talking about residential property sales that aren't financed by a normal lender and where the buyer is some kind of legal entity or a trust. See, these are the deals FinCEN sees as a high risk because they skip the usual anti-money laundering checks banks have to do. And here's something really important to remember. These reports are filed confidentially with FinCEN, just for law enforcement. They are not public records. Now for the core of our discussion. We've got a super straightforward checklist to help you figure out, fast, if a transfer needs to be reported. Think of this as your first line of defense for compliance. First question you have to ask is simple. Are we dealing with residential real property? Now, the definition here is pretty broad. It covers your typical 1 to 4 family homes, condos, co-ops, and even vacant land, but only if the buyer plans to build a residence on it. If the answer here is yes, we just move right on to the next question. Step 2 is the transfer non-financed. This is a really key filter. A non-financed transfer just means there's no loan from a financial institution, like a bank or credit union, that already has its own anti-money laundering program. So if it's an all-cash deal, or maybe it's financed by a private lender without those obligations, then yep, it's considered non-financed. And finally, step 3. Who's the buyer? Look, if the property is being sold to an individual in their own name, this rule doesn't apply. FinCEN is only focused on transfers to legal entities. Think LLCs and corporations, or to trusts. Why? Because those are the structures people can use to hide who really owns the property. Okay, so here's the bottom line. If you've answered yes to all 3 of those questions, it's residential property, it's a non-financed deal, and the buyer is an entity or trust, then ding, 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 that transaction is potentially reportable. The next thing we have to do is check if any specific exemptions apply. Right, so even if a deal checks all those boxes, it might not be reportable. FinCEN has built in several important exemptions, and you absolutely need to know these because they can take a transaction completely off the table. And what's great is how practical these exemptions are. We're talking about really common situations, like granting an easement or when a property is transferred because of a death or as part of a divorce. These things are generally seen as low risk, so no report is needed. There are also exemptions based on the type of entity that's buying. So if your buyer is a highly regulated company, like a publicly traded company, a bank, a credit union, or an insurance company, it's exempt. The thinking here is pretty simple. These guys are already under a microscope, so another report isn't really necessary. The exemptions for trusts are a little narrower, but they follow that same logic. For instance, if the trustee is a publicly traded company, the trust itself is exempt. Again, the focus is always on those entities that aren't already being watched by some other regulator. So let's say a transfer is definitely reportable and no exemptions apply. The million-dollar question becomes, who is legally on the hook to file the report with FinCEN? This is where this concept of the reporting cascade comes into play. FinCEN created this clear pecking order to figure out who has to file. It starts right at the top with the settlement agent. If there isn't one, responsibility falls to the person who prepared the statement. No one there, it moves down to the person who filed the deed, and so on. The key thing to get is that only one person is responsible, and the buck stops at the first person on this list who was involved in the deal. And here is a huge takeaway for many of you watching. Notice who is not high up on this list. A real estate agent, just doing their normal job, is not explicitly named here.
An agent would only become the reporting person in the very, very rare case that they perform one of these specific settlement tasks themselves and no one else above them on the list was involved. Honestly, the chances of that happening are incredibly slim. But hey, what if you want a little more control? The cascade is the default, but it's not set in stone. The pros involved in the closing can use a written designation agreement to formally pass the reporting duty to someone else in the cascade. For example, the person filing the deed could designate the title underwriter to handle the filing. It's a handy tool to make sure the right person is taking care of business. All right, let's pull it all together. We've talked about the what, the why, and the who. Now let's zero in on the essential information you'll need to have ready to stay compliant. So go ahead and mark your calendars. This whole thing kicks in for any closings on or after March 1st, 2026. All the info you need, like who the beneficial owners are, is determined as of the closing date. After that, you've generally got about 30 to 60 days to get that report filed. When a report is due, the reporting person needs to collect some specific info. This includes the basics on the entity or trust itself, but also, and this is key, the personal details of the beneficial owners behind it. We're talking name, date of birth, and ID number, plus info on the person signing the docs, the seller, and the property. This is the data that gives FinCEN the transparency it's looking for. And that brings us to our final and maybe most important question. This rule is a big shift for a very specific type of real estate deal. So now is definitely the time to start looking at your closing processes, get your team up to speed, and make sure you have a system to spot these reportable transfers and gather what you need. So, are you ready?